everybody, it's Greg Schnell, and I am here with the March 1st edition of the Weekly Market Roundup. Thanks for taking the time to join me. There's a lot going on this week. Commodities had a bad week. Currencies had a big week. I'm going to try and illustrate why that's such a big focus for me right now. The breadth is still signaling a bull market. I know there's lots of talk about the S&P closing above 2,800. That's a big deal. I'm more interested right now in the Russell, and it's starting to underperform again. So we want to get in on that. Checking in on steel, lithium, oils. Obviously, gold had a terrible week. So we're going to cover off all of those kind of charts and jump right into that. So let me go grab those charts and we'll get going. Whoops. There we go. And so first things first, I think just a brief look in on breadth would be important. The big thing that we've got going on here is, we've had quite a bit. We're coming to the end of this sort of big surge, and that's not uncommon. Perhaps we'll pause a little bit more, but still everything, in general, this is still looking quite strong. I don't want to sound negative at all. I do want to say that there's a couple of things that if they were going to stall, this is where they should stall, and they did or are. So watching those a little bit more closely. This is the NASDAQ high lows, and what we see here is we're up around 75, which is pretty good. You can see in these big bear markets, we don't get back out of the hole, and when we finally do, this is a good place to get on board. Well, we're well out of the hole here, so I'm happy about that. I think one of the areas I'm concerned about is in this 2014-15 period. We were kind of in this moderate level. To me, the market seems to want to go higher, but overall, in general, we had a lot less participation this week. So here's the global picture, and Shanghai was on a rocket ship this week. But Germany actually was the second strongest performer, and a few weeks ago, I was worried about Germany underperforming, so it actually put in a nice move and broke a trend line this week. You can see the U.S. markets, the Dow was pretty much flat. The S&P was up 0.4. That's not exactly raging forward. And here's the NASDAQ 100. The Russell was flat, and so we're going to talk a little bit about that. But you'll notice that these other markets, mostly commodity markets, Mexico, Brazil, Russia here, not doing very well. So all of those are starting to concern me. And just to keep an eye on what's going on. Again, when oil is bullish, it's usually, it's exactly the opposite of what Kevin O'Leary says. Low oil prices have usually meant the economy's in correction. High oil prices usually means things are going well. So it's different than it used to be, and until somebody gets a chance to help them see the charts on those, it might matter. But what we're going to talk about here is the reason commodities are starting to lag, and I think it's a headwind for us that we need to pay attention to. Anyway, here's the New York high lows, and as we see this breakout on the New York, this is very bullish. And down here we've got the New York high-low daily. So this was a moving average version, and down here is the high-low on a daily basis. And in general, we're where we were in the 2018 period. So we probably want to get more than that going here, and could take a little more thrusting to get that done. But we did have over 500 new highs, net new highs, so 52-week highs. In February. So really a big bullish push here when you look at that. This is the Shanghai, and look at this candle and how strong it finished the week. On Thursday, it was kind of halfway, but it finished with a super surge and closed right up at the top of the range there. So it's that kind of price action that is hard to argue with. This one wants to get going here. We are coming right up to this resistance here. You can see 3,016 here. That resistance level is pretty big for us, so we're going to keep watching that. For the Canadian market, same sort of surge here, and we're up around the 16,000 level, and you can see that that's a pretty important level on the charts. There's some issues with the Canadian dollar that we're going to talk about on that one. And here's the high-low. Again, anything above zero in Canada is very bullish, and so we're doing quite nicely here, and things are looking very strong. The McClellan oscillator, in this case, it actually dipped below zero for the first time since January. So that's like 60 days where it just stayed constantly on one side of the indicator. And we also had our biggest move, I think it's on another one of my charts, on the summation index. In the case of the New York McClellan oscillator for the New York Stock Exchange, this thing went from minus 1,100 to plus 1,300, which is a 2,400 point swing straight up. We haven't seen anything like that in the history of in the 20 years that we've had the indicator on stock charts. And this is the looking just specifically at the summation index here, and this is using candlesticks instead of a line, but you can see this thing is really flying. But again, our momentum this week was the shortest momentum that we could expect. So even if it did roll over here, that doesn't necessarily coincide with a market top, and I want to make that very clear. So here's an example. This is all the way up at the top, and when you come down here, you could be somewhere in here and the market's still got room to run. So anyway, just to make sure that when the summation index tops, that doesn't necessarily mean that the market's going to roll over. This is a more important one for me. Moves below 400 usually create a pullback. Okay, and here's the NASDAQ summation index. And again, look at this 2,000 point swing on here from minus 1,200 to 800. So this is really big in one continuous move. So even off the 2009 lows, we had an interim bounce. So we went up to January highs, and then we pulled back, and then we went all the way back up to get around 600. It was a two-part move. This was a single shot from very, very oversold to very, very overbought or broad summation, broad participation. All of the bullish percent indexes look great, so I'm not going to get into them. We're still stuck at this one level here that's a little bit of a concern. And what I'm more concerned about this, if we were to roll over here mysteriously, there would be one thing that would say we didn't get enough breadth with the percentage of stocks above the 200-day moving average. But I think that's pretty weak, actually, or not weak. It's just a matter of coming out of the hole. I'm more worried about global markets drawing the U.S. down, and so we're going to talk more about that. Anyway, so I'm going to skip over the summation, the breadth indicators from the bullish percent index and move down into other stuff. Here's the options expiration, and essentially, we're up, 10 points or something in 2 weeks from options expiration. So after the big move through, just kind of ground sideways from options expiration. And we did that last time too, for 2 weeks after options expiration. The one coming here in March will be a blue line, and that blue line represents quadruple witching. And that was the major market turn in September and the major market turn in December. So that's going to be out here on March the 15th, so we'll keep watching, and we have a Fed meeting 2 days after that. Here's the Fed meetings, and you can see I've got the blue line here on the chart. It'll scroll in as time goes on. So for the month, for the last 20 days, we're at 4.5%. And, as of Thursday, we hadn't really made any gains since February the 19th, but, that sudden surge on Friday here was led us to a little stronger finish for the week. Year-to-date performance obviously is fantastic, up 11 or 12%. And one thing that's just starting to come into play now is here is the S&P 500. You can see the resistance line at 2,800 and why we're talking about it. Here's the NASDAQ at 7,600 and why we're talking about it. And here's the Russell at 1,600 and why we're talking about it. And again, all of these are at major resistance levels in terms of a head and shoulders structure. So what does that mean? When we're in the uptrend, we make higher highs and higher lows and higher highs and higher lows. When we make a lower high and a lower low, you'd be starting a downtrend. So we have now made a lower low on the big picture here. and then we rallied back up. And now if we were to put in this lower high, again on a big picture time frame, this is over a 1 year period, then we'd start to wonder if we we're making a major market top of some significance. So, it could have happened anywhere from this 2,600 to 2,800. We're getting to the topside level where we'd probably get to. And again, if we started to get up to this 2,950 level, then we'd be looking at testing a new all-time high or making a new all-time high and being aware of that. So I think the big thing for me is this big major low down here still hangs over me with some caution technically, and now we've rallied up so that all three markets are at big round numbers, 2,800, 7,600, and 1,600, and just sitting there. And now the question is, do we have the momentum to get through? And I want to believe we do. The commodity charts were the things that started to slow down this week that bothered me. So here's the S&P on a daily basis, and you can see we made it up to a 20% gain here, low to high, so that's another reason to wonder. And then here is the PPO, and it's rolling over and has given us a sell signal for the first time on Thursday afternoon, or on Thursday's close. And here's the NASDAQ, and what we see on the NASDAQ is this relative strength line is quite important, and there was some work done by a lady named Tony Hansen. One of the things, she was a bit more artistic in the way she approached the market, but one of the things she noticed was when you built your market top, you would have kind of three surges, and then you'd pull back. And then on the rally, what would happen is the market wouldn't have as much momentum. Now, and then it would break down, and basically you'd get three drives to a high over here and fail. Well, we don't have that in the price. We have that in the momentum of the NASDAQ compared to the S&P 500. So it's also making this sort of head and shoulders top in terms of momentum. And if this was to start breaking down right now, that would be a point of concern. And clearly on Friday, we closed with the NASDAQ hitting new highs in momentum going all the way back to early October last year. So right back to where we kind of had the whole market meltdown start. So after 5 months, we're kind of back to where we were in terms of relative strength. Let's keep watching this. Don't want to forget it. But what I do want to talk about, or what I do want to think about here is, as we come up through these levels here, there's a lot of people who are just trying to get back to even. And so just keep watching to see if they start selling into the rallies. Okay. Nothing really there. Let's go down into the Russell. And the reason I want to talk about the Russell is it holds a little bit more importance. And one of the things that we can see on the chart is the Russell started to make new 4-month lows here. And as it did, it pulled down. And when we go back and look, here is a period where the Russell started to underperform after 3 or 4 months. And we didn't make any real headway. And then on the next dip, that was actually when the market pulled down below the 200-day for the first time in a year. And then we rallied up to a new high, and Russell started to get weak again. And as the Russell got weaker, it was still going up, but it was underperforming the S&P 500. So it's when the Russell starts to underperform, and we could draw a trend line here, and that would be an issue. And then we keep going, and you can see right at the market top here, the Russell starting to lose steam and make lower highs and lower lows in relative performance. And we actually get one more push for a week or two here to try and take out that prior high in momentum. And we couldn't. So we had lower momentum on this high, and that's the kind of divergence that we would watch for. So what I'm wondering about now, now that we're in a downtrend, obviously, or have been in a downtrend and a subsequent rally, is the Russell looks like it wants to roll over here. And we also have this big, huge level of support. So a 2-year relative strength support level, and we've just barely gotten above it. If we were to start to lose that, it makes me wonder what would happen. And then the second thing here is our momentum is still below zero. So if it was to roll over under zero, that's kind of how bear markets start. So as much as I want to be optimistic, I'm cautious because of a couple of things like this: relative strength starting to wane on some of the small caps, And if they started to roll over here, that would be a typically normal position to have a bear market start. And maybe I should describe that a little bit more. But here we have in 2015, we had this pullback and then a rally, and we got up to the 40-week moving average, and then the momentum stalled under zero, and we rolled over, and that caused our next leg down. This area in here took 2 or 3 months to build out. We're just here, testing for the first time, but we're still well below zero. And even if we got up to the zero level or just barely above and then rolled over, that's the kind of thing we need to be cautious of, is just momentum starting to wane while we're below zero. Looking at the Toronto Stock Exchange, and again, the Toronto market gets weaker before the U.S. market usually, so it's at least a thing to be aware of. Normally when our PPO is this high, though, we're not really worried about the market falling down hard. I'm going to show you another chart right over here that might add some caution to that statement. But what we see is this really high momentum level goes back to same kind of thing we saw in 2015. And that just really got the rally started. So any pullback was just a pullback to be bought, and life was very good. When we look at, some of the swings in the market here, these are pretty good swings. They're 1,000 points or whatever, so 6 or 7% one way or the other. And now we're up at this high level, so it would be important to recognize that we might be at some sort of an intermediate peak and just need time to relax here. Now it could still definitely keep trying to ride higher, and that would make sense. So if we go back and look here in December, the market still rode higher while the momentum dropped. In October, November, December of 2017, market still rode higher while momentum dropped. May, June, July, August, continually losing momentum as the market gets up towards the prior high. So now we've rolled over, and what we don't know is this going to come way down and then just build a little mountain, or is just gently going to work its way down? And normally from a big, high, enthusiastic momentum level, what we'd expect to do is take time and work our way lower over the next month or two. Now I want to show you the Canadian dollar, and the reason I want to show you this, we're going to get into the US dollar in a second, but one of the things that happened on the Canadian dollar is you can see we had this sudden spike way back here in October 2017, and that marked the market bottom, and then we went on a rally. So basically every time the currency markets changed direction, we saw a change in direction in the stock market. And so this correlated quite nicely, a high here, and as the dollar weakened, the Canadian economy started to roll. And then here we had a top in the Canadian dollar, and the stock market sold off. Here we had a top in the Canadian dollar, and we had the market start to rally. Here we had a top in the Canadian currency, and the stock market fell. And now here we've just hit the line, and we've already been on a run up. So to me, that suggests that we would probably fall down from here, because the other two cases, we had built a base and then started to work our way out of the base. So I'm watching that quite closely, and you can see the downward candle over here on the US, or on the Canadian dollar. It dropped almost a full penny to the US just on Friday alone. And from a PPO momentum indicator perspective, this is pretty significant that we see, barely got above zero and then rolled back over again. And that was much like I was talking about with the Russell. So that adds to a problem. But the other thing to be aware of is anytime a currency starts to roll over, we want to be cautious. And the big thing on the Canadian dollar here is this. You could draw a line at 77 or at the 75.50. The 75.50 has been more relevant lately. But when we slide this slider back, you can see that we focused a long time around this level. And so for us to all of a sudden break down after having this big downsloping trend line, pretty important place to be aware of. Now, the euro is doing exactly the same thing, except it shot up towards the top of this line, and so we'll see if it's got the power to actually get through. Okay, so that's the one caution that I have on the Canadian market is this, the big move down on the Friday on the currency market here. Canada announced their GDP, and it was quite a bit slower than everybody expected. But you can see a lot lower momentum on this last peak, and it's that much slower momentum that we'd be worried about experiencing in the overall stock market. So while we're up here testing the highs and this starts to break down, a weak currency can sometimes be good for your stock market, but other times it indicates a weak underlying economic condition. And you can see back in 2014 when oil topped, the Canadian stock market got roiled, and then even here, while the currency declined, so did the Canadian stock market. So it's not always that a weaker dollar helps your stock market. Okay. Next, I want to cover off the Japanese market. And the Japanese market is really an odd one for me, and I like to keep track of it. It helps me with gold, sometimes trading gold. And then the other side of it is I think it's a good economic market to follow as one of the developed markets. But the other thing is they, as I've mentioned many times, they have a weak set of demographics, a very high debt level, a GDP of zero, and eventually you kind of wonder if it doesn't run out of steam. And right now the central banks bought over 80% of their ETFs. So, you know, we probably would have worried at 30 and at 50 and at 70%, but now we're at 80% where they own 80% of all of the ETFs, and by whatever, the end of 2020, for sure, they'd own 100% at the current rate of buying. So if all that stimulus hasn't been able to improve their markets, when does the global economy start to pay attention to the real major structural issue in Japan with all of their debt and start to worry about the debt levels? So we've had a rally back up, and we're still a little bit away from a nice round number of 22,000 and the moving average. So we're sitting right around those levels. And on this rally back up again, anytime you get these big breakdowns, if you just unwind the markets in history. So one of the things that's beautiful is just to be able to kind of wield this back. I could even go back a little further in terms of years. Let's just go out 30 years and I'll show you a couple of odd things here. What you'll notice is when you're above the 200-day moving average, it's fine. And you get these brief moments below, and so you have to just kind of check your work and make sure everything's okay. And then we have these big moves up. But major tops happen when you fall below the 200-day moving average and then try to rally back up, and you can't. And that's typically where they stop on big market rollovers. And while this doesn't look like much, this is a couple of months in the works here where you come below, come back up on a big rally, and then fail from there. So it just, as a general rule, as you come up from the bottom, you want to make sure you get through. And you can see here we fell below, rallied back up, and then fell down. And this Japanese stock market's been, this is level 21,000 for the last, call it 25 years, 1993. And here we sit at 21.6. So we're still at the same levels. And again, we're below the 200-day, and we're checking from the bottom to see if it's got any momentum to get through. And it's a good reason to watch. So just in general, why do we use the 200-day moving average? Well, because typically it's at least a place to check. And again, some of these it gets above slightly, and then starts to fall apart. So I think the biggest thing for me is just always being aware of what's going on in that market. Now we're going to talk a little bit about the US dollar and why that becomes more interesting. So the US dollar this week ended up opening relatively similar to Friday's close, fell all the way down through the week, and then closed Friday on the high of the bar and above last week's close. So this is what we would call a buying tail, where you test lower, but you end up closing higher. And this just looks like a giant candle wick sticking out the bottom. So if I just convert this chart to candlesticks, maybe that becomes more obvious. So it's this big kind of wick that we have hanging down here. And these buying wicks are typically what you see showing up on the bottom, and conversely on the top you get these big selling wicks where you tried to go higher and through the week and then you couldn't hold it into the weekend. So now the other thing that we need to worry about is momentum. And the big issue here on momentum is as the momentum is rolling over, the real question here is what happens. And so one of the things that's most likely is it looks like it's ready to roll down. And if that's the case, then the US dollar is going to fail here and we'll probably see a whole world rally. And that's what we keep working towards expecting. Well, even as late as Thursday, this looked very plausible. Now, the problem is with this big buying wick on the Friday to push the whole week back up and close near the highs. If the US dollar comes down here, breaks out to the upside, that changes a lot. And again, we keep trading in this narrow range of a couple of pennies over the last 6 months. And so if everything is going to start to break out top side and not bottom side as the momentum has started to indicate, but if all of a sudden it was just a pullback and then a surge, that would be very meaningful for us. And we need to know that specifically to make sure that we're ready for a big rally to take place in the dollar. And then all of a sudden, a lot of things get traded off that, including world markets and stuff, which I would expect to go lower if that was to happen. So I expected the euro to be weaker on that news, and it didn't. So it was mostly in the yen. Anyway, the one point I'd like to make is on this 97.5 level. This goes back all the way to 1980, and you can see 97.5 has been a defining line for the US dollar. And so if we're going to come back up to that level, we really need to figure out which way it wants to break out. So that is a very big control point for me. And here it is on the daily, just in a line chart form. And again, as this started to break down and go below the 65 period moving average, this looked very bearish. And then all of a sudden to finish right back up at the top on Friday was pretty strong. And you can see this downward momentum line on the dollar, and then an upsloping line off the last few lows in January and February here. And if we make a higher low again in March above zero, this is probably exactly where you would expect a breakout. So this is making it much more difficult. And perhaps this is a good example where you come down here, and as you go above zero, then all of a sudden you get this sudden surge. And so this move back above zero as we're or back above the 65 period moving average just as we go above zero, and here we are just moving back above the 65 period moving average after being above zero, pull back gently and then take off to the upside. Same sort of scenario that we had in here where you pull back gently and take off to the upside. That's what we need to be aware of. And if that was going to happen, it doesn't necessarily mean the U.S. stock market tops right away, but it does put a lot of pressure on the rest of the world where they basically did not rally all the way through the summer like the U.S. markets did. So getting into, this is UUP, just the daily, and you can just see there's such a trend line here that everybody's watching, and it goes back almost a year, 10 months now. And the KST, this is Martin's KST, and I have my PPO up here. And as this starts to turn higher, if this was to start to turn higher and break out to the upside, Martin's is sitting right on the line, you can see. And so it looks, it could just as easily go higher or lower. We don't have an answer yet. And so critical to keep watching the dollar to see which way it wants to bend. Again, the euro makes up a big part of the dollar. And one of the things, here's the candle for the week. And what we see is the euro finished right up near the highs for the week, and a big move off of last week. So we were way down here with a buying tail, and then we had a big up week and another big up week and closed near the top of the week. So it looks like the euro wants to break up now and not down. And, it's just very difficult to figure out a direction week in, week out. But if the U.S. dollar was about to surge, then I would expect, this to probably pull down much like it did in 2018, where I just showed you on the U.S. dollar daily chart. So the interesting thing is here's the euro, just different look, and what you see is two converging trend lines, and the DAX just recently tried to break out above it, and we're coming up against this resistance line, call it 12,000, but it's a little bit lower than that, maybe 11,900. And so as the currency breaks out here, does it break out to the upside and then the DAX ends up topping at that point, or does it break out to the upside and support the DAX? So really pivotal questions for us, and I don't have the answer. Everything's still within the trading range as it was. The one thing that started to give us more of an answer, I think, was the yen, and we're going to get to that chart right here. Okay, so here is the yen. And what happened on the yen, and this gold line is the price of gold. And last couple of weeks, we mentioned that the yen is going lower and gold is going higher. One of these two is going to be right. Who is it? And we kind of suspected it was going to be the yen because the gold was up against resistance, and sure enough, gold had a really tough finish on Friday and pulled back hard as the yen fell below its 65-period moving average. So this broke down, but I'm just going to go get the yen chart on for the article that I'm writing. And the one thing that I did on this chart was I took out the histogram, and by taking out the histogram, you can actually see the line, whereas on the chart I have over here in my indicator, it's all kind of buried with the histogram in front of it. So by taking out the signal line, you get rid of the histogram in the background. So this curl over here that we're seeing on the yen, I want to show that to you on this chart. And here we have, remember the importance of going below zero on momentum. So we're failing here right at the zero level. And again, the US dollar looks like it wants to do exactly the opposite. And what we notice is a couple of times when the yen has failed, this has been massive moves down. And as you get these massive moves, it's pretty critical to be aware of them. Same could be said about this one in here. These two, as they broke below, they didn't do anything. Broke below and didn't do anything. And now what we're wondering is, now that we've put in our third lower high and we're right at zero, does this actually break down hard and we have another big move lower in the yen? If so, that's usually bullish for the Nikkei, and we would expect the Nikkei to break above this, call it 21,000 level that it's sitting around. So if the yen is going lower, I expect gold to go lower too, and that would probably be an important trade to be aware of. Going back to all of the big moves, most of the commodities topped out in 2011, and here's the yen topping out in 2011. Gold made a subsequent rally in 2012. Couldn't take out the prior high, kept working its way lower, and as we know, a lot of the commodities have been consolidating sideways for 4 or 5 years now. And so with this yen getting into this narrowing pattern, the real question is which way is it going to break out, obviously. And if it's going to break lower, we see the PPO on this really big picture, so we've got an uptrend going on for 6 or 7 years. We have lots of room to move down towards that uptrend line just to get reset here. But the real question is this uptrend line in price, if this was to break down, do we go back and test the 80-cent low, or do we go well below that? And we don't have that answer just yet. But that's the big implication here of falling back below the 65-week moving average. It was pretty good support for many, many years. In here, it became resistance. In here, we broke above it. Market shot up in a big way, came back down, actually failed at this support level and fell right through, became a lid, broke out, strong move, came back down, fell below, tried to break out again. And you notice the rallies are getting, so this was a big rally, a littler rally, a littler rally, and now we're back below the 65-week moving average. So quite an important place on the charts, in my opinion. I think we're in a really big zone of caution for the yen, and a breakdown in the yen is something that I am very, very focused on. So what I don't want to see is if I want to be bullish commodities, I want the yen to go higher, and if I see the yen go lower, then I'm probably going to be more bearish, especially the precious metals. Okay, so the Canadian dollar, I mentioned those kind of correlations between the peaks and valleys, and what we're worried about here is this 77-cent level here. The Canadian dollar's been wrestling with it for 4 or 5 years now, and if it can't get above it, that would be quite worrisome. And again, it's below zero here, so if it rolls over, probably see another move to the downside. The Australian dollar didn't really give us any clues this week. What we were expecting was, I thought it might actually follow the breakout of China with the Chinese stock exchange taking off. It would suggest to me that we'd probably get more bullish commodities, and we might just start to see the Aussie dollar run. The PPO, that's what it's trying to tell me, is it's breaking this downward trend line. But if we don't get the subsequent move in the price and this just goes up and rolls back over, we'd be below zero, and rollovers below zero usually mean, pretty big moves down like we saw in this zone in here. So watching closely here, again, what I would have expected to happen didn't happen, and that concerns me a lot more. So this yellow or orange line in the background here is copper, and what we saw is copper surged, but the Aussie dollar didn't, and we saw that same situation back in last May. And if I would think, because this didn't follow through, I'm really worried about the strength of this copper move now. Okay, so let's get into some of the bonds are crazy this week. Lots of movement there. So LIBOR was rolling over, and the momentum is just about to go below zero. Hasn't been down there for 4 or 5 years, but not so fast. Things started to improve a little bit on some of the longer time frame charts. LIBOR is a 3-month borrowing rate between the banks. But here's the junk bonds. And this couldn't be more interesting. We have a trend line break, and immediately after it breaks, what we see is it just basically stalls. And look at where the PPO is, right at zero. So if we were going to stall under zero, look how fast the junk bonds moved down. Last time it stalled at zero. So it's just an important place. We don't know if it's going to stall at zero yet, but the histogram actually went to just flat for the week after been running up quite significantly. So I would say we're all of a sudden junk bonds pause. Doesn't mean it's over, but it does mean warrant more inspection. And here's the Treasury bonds. What we see here, 7 to 10 year, and this rolled over below its 10-week moving average, and it's been above it, for most of this rally out of the hole here. It started to rally back in November, and now we're doing the opposite. And bonds can lead or follow, don't have to hit the same time, but when you get these big moves down, they're pretty important. And so the real question we have here is look at how this momentum line, and this is similar to what I showed you on the Nikkei, how it just gets up to that line, hits it, and then rolls over. And we saw this on the 10-year last year. So for this to fail at momentum, going back on a multi-year time frame, pretty significant. And I think this could move down quite quickly. So bond prices falling, interest rates rising quickly. Now here's the corporate bond market, and Paul Tudor Jones keeps saying this is the next place for trouble to show up. And I shouldn't say keeps saying, he said it once and I wrote it on the chart. But here we are, we pull back down, we rally up and have a very weak rally, and it looks like we're about to roll over. Histogram starting to decline already. And if the corporate bond market was going to start to fail here, look at this big trend line going all the way back to 2012. So a check on that goes up and fails again, I would expect a significant move down. And look at our PPO, just barely above zero, rolling back over. Lots of reasons to be concerned there. And again, in this case, all through here, the bond market was climbing, and so was the stock market. Then through here, the bond market was sideways and the stock market was climbing. maybe there's no correlation, but it's good to keep it on the charts. But I will say that in 2018, here's what happened in October. This was kind of when the bond market broke this trend and started to roll lower. So if we're going to do that same thing again, are we going to see the same pressure on the stock market right after we get back up to test the highs? Don't know the answer, but now I'm starting to watch that. So here's the 2-year. And again, this 3% level was a pretty good ceiling. And one of the things I noticed on this big long time frame chart was that it wasn't uncommon for us to test the 70 level and hang around there for a couple of months, maybe 3 or 4 months. In this case, same thing. And then as we started to work our way lower, now this was 2000, this is 2007, and now this is 2019. We all want to be bullish, but we're also starting to get these big moves in the market that might suggest we're building some sort of a topping structure, and the fact that it coincides so nicely with the RSI highs is somewhat concerning. The TIPS market is the inflation protected securities, and what we see here is this big downward trend line, really having trouble. And we see this chart. So this is gold and copper on here, or no, the yen and copper on here. And when we start to see both of these failing, it suggests to me inflation protected securities are probably going to start dropping, which is usually lower for commodities. Here's TLT, and again, this is, I mentioned it last week that it was rolling over, and sure enough, really tough week here for the 10-year Treasury, rolled over right at former resistance, call it 122, and this is the unadjusted version of the TLT, and what that means is we've removed the dividend, and this is just price. So when we look at this chart here, you could just see this narrow trading range between 118 and 122 going back for most of 2018. And then in September, October, as we broke below, this started to become worrisome. Well, here we are going back below again. So is this going to mark the start of the market problem again? So the one chart I mentioned was the corporate bond market. This is the treasuries. Now the muni fund, I like to use this to help me with direction on the bond market, and this continues to push higher. So it broke this giant 10-year downtrend, suggesting that perhaps the bond market was ready to take off to the upside and in price. And so that's a question for me, but this also looks like a big major topping structure. And so to see TLT roll over and the 7 to 10 year IEF roll over, and yet not to see this MYI roll over, at this point they're in disagreement, and so we need to see what wants to go on here. Okay, here's the 10-year bond yields on a monthly basis, and you can see last month we had a relatively short price bar, and this month we're pushing it higher just in one day, so can't really use that information much. But I will say that the momentum has rolled over from a very significant high. Last time it did that was 2014, and of course the market didn't really crack until the fall there, so it's not a great timing tool, but one of the issues that we've got here is this is a significant momentum level, and even if it needed time to work its way down on this monthly chart, it's telling us that the momentum to the upside is definitely waning, and it would be difficult for it to kind of recapture that same sort of enthusiasm. But here is the weekly, and what you see on the weekly is we had a nice big outside reversal bar where it took out basically the last 2 months of trading, and on the lows held and now got up, and we're at new 1 month highs, and it wouldn't take very much to get to new 2 month highs or 3 month highs. We are under this big moving average, so we'll just see what happens. Does it rally up and then fail? This is the yield, so the opposite of price. So if yield's rising, price is falling, and that's what that IEF chart was saying in the TLT. Okay, here is the 5-year. And what we see on the 5-year, again, trying to bounce off this trend line, looked like it was going to break down last week or two, and then all of a sudden it's reversed and started to go higher again. So it looks like that trend line is going to hold for now. Lastly, on the 2-year here, we just see that, we rolled over, we moved back above the 10-week moving average or the 50-day moving average on Friday. And so just something to keep a watch out. But I would say the bonds are very much in flux here, and the currency is probably a big driver of that. Wasn't a lot of news in the transport, so I'm going to skip over that this week. I will say a couple of charts that surprised me was the broker-dealer index had a doji bar this week where it basically opened where it closed or closed where it opened. And here's the utilities chart, and it looks like it wants to break out to new highs, so that might also suggest bond markets lower, and these utility stock markets can go higher. Industrial sector spider. What we see here, to me, one of the things I'm really focused on this chart is you see this high and then a low, you see this double top and then a lower low, and then you rally back up and you can't make it back up to the prior tops. That would be quite concerning. So we're testing this downsloping trend line on the PPO. It could still, go up and just make a slightly higher high. But if it gets any weaker right here, I'd be quite cautious and make sure it doesn't want to make a bigger low, a significantly bigger low. Okay, so here's the CRB, and what we see on the CRB is, again, we keep trending right around this level, this 182 level, been on the charts for years now already. And you go back and look, and the problem we had was, this is only 1 month of data. We'll just go to the weekly here. But last week we had closed above the 20-week moving average. This week we reversed and closed back below. Now, typically what you see when you go look, 20-week is a pretty good place to expect support or resistance. So here it would have been here, and then here we start to break through, and then it becomes support all the way up with a couple of 1 week where it closes below or something and then rallies again. And then on the way back down, it becomes resistance. It's a gray line over here and keeps coming down. And now we're at resistance. So not happy to see that at all. And the other thing is the PPO is just getting to its trend line. So if this trend line was going to break, we could see a big move down in commodities, which would also suggest a big move up for the dollar probably. For the broader commodities, I think one of the things to be aware of is we tried to break out here at this 1575. So this is the total commodity group, and it rolled over. And grains didn't have a good week this week either. Wheat was particularly poor. And so for the last 2 weeks, this breakout is failing to hold, and it looks like it wants to go and break down now. And the uptrend also looks like it's breaking here. And that's for commodities overall. Looking at oil and natural gas, oil is having trouble making higher highs here. It's starting to wobble a little too much. So that also suggests caution. Natural gas can do its own thing. Again, while oil was falling, natural gas was soaring. And then natural gas started to fall and oil started to rise. So these things can move opposite of each other, and they do. And we're starting to see a bounce here on natural gas. Looking at heating oil, it looks to me like it wants to break this upsloping trend line, and gasoline basically put in a 1 week move, and now it looks like it's rolling over again. Corn, soybeans, and wheat, and what I mentioned, look at this move down in wheat over the last couple of weeks. Soybean holding sideways and corn down slightly on the week. Just nothing really strong in the whole agricultural area, which would make it easier for us to be invested in, but we're just not seeing that. Gold and silver, this chart is worrisome because we've fallen below the 10-week on gold, and you can clearly see a topping structure here. And look at what silver did. Not only did it fall back down, went below the 10-week, but it's also starting to go back below this trend line. So this looks like a failed breakout, and usually these failed breakouts tend to attract a lot of money trapped, and then it makes an extreme move the other direction. Copper got up to the neckline here of its prior closes. And as I mentioned, we didn't really see that follow the yen and gold and a few other things like that. So looks suspect at this time, and kind of worried that it's another one of these false barbs and it ends up pulling back down. So have to stay watching that. But typically, the Chinese charts were improving. So that was one of the reasons I was starting to like metals. But this industrial metals, if copper doesn't continue to hold here, I wouldn't be too fussy on trying to prove the world right. Just put your stops in and make sure that if you get hit, you're out. Sugar and coffee, nothing really to talk about here. These both broke down and they just continue to dawdle. Sugar was starting to look like this was going to be a big breakout of a 2-year trend and another failed breakout. So again, makes it hard to own when that keeps happening. Here's the marijuana ETF, and one of the problems on the marijuana name, so I'm starting to get quite bearish on them here, and if I'm wrong, I'm relatively close for a stop out. But what you would see here is, we're getting up to around this 22 level. The concern I have is the full stow is up nice and high, but look at where the PPO is. It's making lower highs and lower lows. And if it was going to start to fail, this would be the place we'd expect it. Coal, again, broke out and rolled over. Steel broke out, rolled over. Nothing bearish yet, but notice exactly where these trend lines, horizontal support resistance level is right at 40. We see that up here at 14. So both of these ETFs could easily move lower. Lithium and rare earth metals, and what we see on lithium is it's popped up and it's still holding up. There's an upsloping trend line here that we can use to help us. And on rare earth strategic metals, it had another positive week to follow on to last week's positive. Just no real support from the rest. So anyway, at least it looks like it's trying to break out here, and hopefully we can keep that one running. Let's go looking on the energy sector specifically. And what I want to focus on here is this XLE put in, pretty wide range over the last 2 days. And I don't have a feel for it. I heard a trader on TV say, he expects 55 to hold on crude oil and wants to be bullish all the way to $60. I'll show you the crude chart in just a second here. Crack, the refiners ETF. This one, remember I mentioned the Tony Hansen wave where you kind of have these tops, then you have a pullback, and then you really have trouble getting enough momentum to break out, and then it makes another leg lower. So the refiners are starting to look weak like that, and be a little bit more cautious here. You can see on relative strength, they're starting to make new 52-week lows here for the first time in a long time. So that is definitely cautionary. Frac, the exploration and production ETF, just held in there, didn't do anything all week. So no real answer either way. And that's just the daily. Here's the weekly. So crude oil at $55 here. You can see we got up to 58 and now pulled back to 56. And this trader thought that $55 would hold and wants to stay long because you're in an uptrend and all that kind of stuff. Fully get it. What I'm more worried about, look at our momentum trend here. This is about where we'd expect it to top out. And then the second component of that is obviously the US dollar. And if the US dollar was to start break down and start to break out and all the commodities start to go lower, I think that's a bigger deal. So here's XOP, and one of the things on exploration production ETF, it's trying to hold above the 50-day moving average. Crude is well above the 50-day moving average, so the fact that they're not more in step is a bit surprising. But the second component for me is also that the if we start to see further weakness in this exploration and production, you probably just want to let somebody else own them for the near term. Natural gas, trying to bounce off this horizontal support. So if there was a place to buy it, it's pretty much right here as it made new 4-week highs this last week and starting to make the turn on momentum. But I think the bigger reason is it's not correlated with anything else. So the more that you can, have an independent sort of action plan in your portfolio, regardless what the market does, and just trade its own price action. Pretty important. And what we see here is, the relative strength has been downtrending. This is Chesapeake Energy down in the bottom, and it's starting to try and break this downtrend and move to the upside. Even though crude pulled back $2, this actually put in a higher close on the week. So, okay, let's get into nuclear, because this is continuing its indecisiveness. So I've got this megaphone pattern here, and essentially that's indecision, when we don't know which way the market wants to go, and it keeps higher highs and lower lows, and we keep stretching it out. And so here we've got this pattern extending out. We had some volume, but on the last rally, nobody showed up to buy, and that's a real concern. And if we look over here at URA, so NLR is the power plants, URA is the actual metal miners for uranium. And we see that this chart's breaking down actually pretty hard, so that is not encouraging. And on a weekly basis, you can see that this trend line is still desperately trying to hold, but it looks to me like we're rolling over, and now we've fallen below the 40-week and the 10-week moving averages, and we're below zero, so a rollover here would be significant one more time. Copper, again, I mentioned earlier, it had just gotten back up to this horizontal support and resistance level. We can see it quite clearly on this chart. PPO is back above zero, and this looks to me like it wants to accelerate significantly higher. Same sort of price action there, but we haven't got that yet. And so watching closely, just because nothing else followed this copper move higher. Here is steel, and what we see on steel, this is an ETF, and it got up to this resistance line and just stalled there this week. It's also the 40-week moving average. I still want to believe that the commodity rally can go forward if the Chinese market wants to keep rallying, but look at how nobody started to buy this at all. The interest level is just horrific. So that makes it harder to believe that it has the power to break out, because you need volume and you need institutional investment to kind of push that higher. Aluminum sideways, no real price action, a little bit of volume for the week, but that chart's got low volume on it anyway. Here is the metals and miners from the US, an ETF, and it looks to me like it's rolling over right at resistance, so that's a problem. And the Canadian chart is even sharper, showing that we're rolling over here. Resistance was up slightly, but if this trend line on momentum breaks, I think I'd want to be out of it. And here's a good example back in June, July. Okay, getting into gold, the big move this week was to the downside. And again, gold ended up closing lower by about $10 or $20 on the month. So not great by any stretch. And the fact that it's rolling over kind of right where we would expect based on this PPO height, this is where the last rallies have all died. So now that gold's put in that big down move, I think we could probably see an acceleration that way. Very clear that the uptrend is broken. Momentum was waning anyway, and now it's kind of confirming its weakness. And there's the big base we talked about in gold. So here's the 2011 top, the 2012 retest that coincided with the Nikkei. And then we come down and we make this giant base. And the yen has correlated with this chart, but it ends up that it's filled down lower. It didn't get all the way back up to these kind of 2013, 2014 highs. But in this case, we've started to see the yen leave, and now gold looks like it's going to fail at a back test of the uptrend. So technically a pretty important bearish signal there. GLD, just a little bit closer look. You could just see the resistance on these ETFs. So we had marked the caution on there a couple of weeks ago, and it looks to me like it's falling hard now. The gold and silver ratio, the gold miner ratio to gold, clearly topping out right where we might expect it to. Same thing on the PPO. So lots of things saying sell, sell, sell all over this. So with that, thanks for watching, everybody. Have a great week. Bye-bye.